What's up, BatFam? Here we are on the chart. This video I'm going to be introducing and explaining what liquidity and what liquidity concepts are, show a few of the trap models and situations that are directly out of the BAT playbook, exclusive to the premium channel and students, and explain what fakeouts are and how they all go together. Okay, and the following videos after this will show more examples and go into a more in-depth explanation of these concepts and why they do these certain things. So, first things first, we're going to talk about liquidity. What is liquidity? What are liquidity concepts? And where does liquidity come from?
All I do is daydream. They've been sleeping on us, I'm just trying to see what they...
So first things first. Have you ever noticed in certain trades you get in, you expect it to keep going or break out, whatever, and it reverses on you, even though you see a textbook pattern or trend line, whatever it is? Well, the reason for that is the market needs to engineer or create certain situations to make you think something's going to happen when really another thing is going to happen. It needs to do this and trick people and trap people into certain movements in order to move the market in the overall anticipated direction. So sometimes even when you're right, you might get taken out and lose a trade before it happens. So for example, there's certain areas, certain things in the market that were taught or traditionally were taught, right? So when you first start trading, you're taught about lower highs and lower lows, market structure, and then higher highs and higher lows, bullish market structure, right? You're taught after a higher high comes a higher low, and then after a lower high, lower low. Stay away from ranging markets because it's moving sideways, right? But there's way more to it than that, okay? There's way more to it than just trending and ranging markets. Because in theory, this is easy to follow, okay? But if it was this easy to follow, everyone would be able to make money. So there's things that happen that are engineered to trick you or to trap traders before the actual move really happens, okay? Because everything you're learning is just theory, right? And then when it comes to the actual live markets, it's a lot more difficult to apply what you're learning because emotions are involved, real money's involved, okay? It's not a backtesting session anymore. It's not just candles moving, you're watching your P&L fluctuate, you have, sizable risk on, emotions are involved, everything like that. So even in certain situations, when you catch the top of a move, expecting a lower low, or catching the bottom of a move, expecting a higher high, and it comes back and takes you out. All these certain things are known as liquidity or traps, right? It's meant to take your money, meant to take liquidity from the market, and ultimately trap traders, okay? The liquidity comes from us retail traders and other hedge funds and institutions, but what drives the markets are the big institutions and the banks, okay? All we can do is just hop on with what they're doing and profit in the right direction with them, okay? We cannot trade against them because if we trade against them, we lose. They're the ones who really move the market. There's certain things that you need to be aware of, such as trendline liquidity. As we know, you can draw trend lines in certain areas. When the market is trending, you can draw another one here. So trendline liquidity, trend lines as we would know them as retail traders, drawing our trend lines when the market's bullish or bearish, along with the trend, and inducement or ranging markets, when the market's consolidating and going sideways, like right here. And fake outs when the market creates these strong wicks at the tops and bottoms of these moves. Right here. Oops, sorry, wrong tool. This wick. Oops, sorry again. These wicks. These wicks, and essentially you get the whole point, right? these areas of strong exhaustion / rejection. Now we're watching for these things. We're watching for ranging markets, the inducement, watching for trendline liquidity, trendline areas. We're watching for areas of structure, higher highs and higher lows. We're watching these areas of exhaustion, which are typically at areas of supply and demand and the edge of markets, and they're meant to trap you into the market and to make you think something else is going to happen before it reverses or before it retraces, before going back down to your anticipated direction. Okay, so let's go over a few examples. Liquidity concepts are not that hard to understand. In fact, don't think too much into it. But really, the market needs to trick people into thinking something else is going to happen most of the time, right? So usually when you get in on a good move, and then it comes back, and then it takes you out, and then it goes back into the way you thought, or you enter a little too early, and then it goes, against you, or, whatever the situation is, when you ultimately lose before the move plays out, it's because a lot of times you might not understand these liquidity concepts, or you might get in at good areas, and price reverses on you, even though what you've been taught is to buy or settle at these certain areas, and it doesn't work. It's because of these concepts here. They as in the hedge funds and the banks and their algorithms, know exactly what we're taught, so they do the opposite, which is why a lot of times what we're taught and what we're doing doesn't work, or doesn't work nearly as consistently as one would think, because they do the opposite of what we're going to do, and then they push it back into the overall direction that we anticipated, or the market reverses entirely, whichever it is. Okay, so first we're going to go to the BAT playbook here, some of these pages, and this is what we're going to be looking at, these certain setups. Here it is. So inducement, ranging market / inducement, to look at sell traps and buy traps. Okay, these situations here. Just these two for now. I have a total of 4, and there's more pages added every single week. So, if you're interested in that, consider joining the premium channel. The premium channel is only $50 lifetime, and you get a ton of resources. And if you just want to learn for free, I have a YouTube channel, obviously, you're watching it, and a free Telegram channel, which is right here. It's currently 139 members in this, and in the premium channel we have 14 members. And you also get a exclusive student chat that I'm also in, and there's 10 of us in here. So there's lots of value on top of other additional services in our group. So now, the first two situations I was going to show you was inducement and buy traps and sell traps. Okay. So first we're going to go to an area where the market is ranging, trying to induce traders in. Okay, so there's risk to reward tools all over, just because I was back testing earlier, but here is the chart that we're going to be looking at now. There's a few things you need to understand about inducement. Okay, one, it's going to be low volume and choppy, and you might even be right about the move that you're seeing, but something needs to happen first, either a strong move to the downside or the upside, and then for it to go the opposite direction afterwards. Okay, like right here, you might be thinking sells overall, but what needed to happen first, this move up before it went down, and again right here, this move up before it ultimately broke down. Or you could be thinking buys, but you bought right here and then had to go down first before it pushed up back into the range or / area of inducement. So essentially, this is what's going on here. So let's say you get in for a sell back here, and you're anticipating a lower low point, let's say right here where the market broke resistance to make this move up here. You're going to target it as support and as your take profit point. So let's look at something here. And look, just how I have this risk to reward tool, how you most likely would have it, or just slightly above this high. You see the bearish candle, you enter on the next pullback. Exactly as we're taught as retail traders, stop loss above the high, and most likely would have got taken out on this, right? Most likely, right before the move happened. Or And the other scenario would be breakout trading. Entering on the break of the low, and it's snapping right back in, right? You can see this bearish candle, boom, coming back. You have your stop loss just right above here, or you're trailing it behind the lower time frame candle, and it snaps right back in and takes you out right before going down, right? So that's why you need to wait for certain things to happen. You have to wait for these movements to happen first, these liquidity movements, these downside breaks, these upside breaks, and for the candle to flip to the direction that you're anticipating, right? The exhaustion, the wicks, that's what you're looking for. So in this situation, here with the arrows, we have in this area right here, this is what happened. Had to move up, try to move down, closed. This candle opened, had a little pullback, had another bearish candle, went down, pullback, moved down. Now I'm moving sideways right here. Okay, snap right back in, tight range, broke out, snap back in, broke out a little bit, snap back in, and then ultimately broke out and retested and continued down to this area down here that you're originally targeting. So in this situation, let's go to the playbook here. So we have our sell scenario, just like this, okay? You have to wait for these wicks or exhaustion to happen. You have an overall sell bias, right? Because you saw a few things that happened. One, you saw price reject strongly from this higher time frame area of supply. Now I can zoom out, but this is going to look a little messy, so I'm not going to zoom out to a higher time frame. We're just going to stay here. But this is a higher time frame area of supply and resistance right here. You can add a level of resistance right here, and essentially a strong reaction. You could even draw another supply zone here, right above, right in this area here, because that's actually where it fully tapped. But as you can see, both these areas have a lot of confluence, making it a high probability area for sells. So we got that strong rejection, strong bearish candle, broke lower time frame market structure, made a lower high, continued making bearish market structure until we had this little area of inducement. Then what happened? You can see we have our sell bias like we were saying. You understand that for price to continue bullish, it has to break this area, this little area, this lower high point, break out of this range, like how it made those wicks, making it look like it made a higher low point, push bullish, make a higher low, and then make a higher high. That's what has to happen for this inducement, for this range to go bullish, right? That's a lot that needs to happen. So this was designed to trick you. This was designed to trap breakout traders as well, making them think the lower low point is going to happen. Didn't happen quite yet. Okay, this is also get people to think, oh, it's a reversal, it's going to go higher. Didn't quite hit this area of resistance slash support now, right here. The market must be going up. Okay, and then what happens? Candle reverses, traps these buyers in, sellers get in, traps the sellers in too because it takes them out on this candle. So you need to wait for these certain areas, these certain things to happen, the exhaustion, okay? Now you can still take trades in this range, in these areas, but you have to be mindful of what's going on. You have to be mindful and question whether you are in an inducement or not, because these happen at certain time frames, certain time zones, certain times in the market, and a lot of times it's right between New York session and London session. In this example, it's 1 a.m. to 7 a.m. up until the following day the market finally broke out. So this trading session was pretty rangy and choppy. So ideally you want to stay out of this, but you can identify this simply by understanding the market is not breaking out of these areas and it's just moving back and forth. In the moment and in times like this when you're trading, it's very easy to get sucked in and end up getting trapped and taking bad trades and taking all these unnecessary losses in these areas before the move happens. You need to be able to step back and reanalyze and come back after a few hours or an hour, whatever it takes for these candles to close for you to get some clarity on what's going on. Because look, you go to this lower time frame here, it's a mess. Okay, you're going to be getting caught up in a lot of this. You can definitely take some quick short-term sells and buys, but ultimately it's a mess and you want to stay out of it You want to stay out of these areas until you see those reactions, right? When it breaks out of the range or snaps back in, and when you see it break out, these wicks, these exhaustion, when you see the liquidity being taken, they're also known as fake outs, false breakouts. You want to be waiting for those points when you see inducement / range. Okay, so we're going to go over another example for a buy side example. Okay, essentially this is all that's happening right here. So lower highs, lower lows. Oops, sorry. Lower highs, lower lows. Right, and a inducement, false breakout to the downside, move back up into the range, false move up before coming back down to the overall anticipated direction. Okay, some of you could call this smart money concepts, but I don't really use the terminology like that or trade really like that. I just view it as price action and understanding price action very well, and utilizing liquidity concepts and understanding how price action forms these sell traps and buy traps. But however you understand the market and whatever terminology you want to use, go for it. But this is exactly what's happening, okay, in this situation right here. This happens over and over and over every single day. A lot of times these lows are at the end of the Asian session, or the Asian session lows, and then you see the end of the London session or the start of the London session, whatever one, come out and take these lows, and then the price reverses, and then during New York it comes out and takes out the Asia high or the London high, making you think market's reversing before ultimately breaking down to the way that you thought, right? Or the way that ultimately into the direction that the market was supposed to go in anyways. So next example, you can see the same exact thing but for a buy, right? So let's go back to the playbook here. Buy scenario, same thing, series of higher highs and higher lows, over time frame structure break, consolidation, inducement, false breakout before the move up. Okay, so let's go right here. Similar thing. Now right here is not the best example, but we're going to go with it because it's still there. First things first, you can see resistance broke here. A lot of people would be taking sells, they see this projection, and boom, price closed bullish. We're taking a buy on this candle right here, we're retested and totally continued higher. But essentially we're in a range. Okay, right here. Now right here was not the strongest fake out, but we did have a fake out to the upside. False breakout to the upside, trapping buyers, early buyers in, and sellers, trapping sellers in before coming back down, retesting this area, and ultimately breaking higher. So what do we have here? So we have that large move up, higher low point, move back into resistance, small rejection, a little consolidation, and then it ultimately broke higher, came back down, retest, first move up, higher low, lower high, and then started consolidating, basically making lower time frame structure before we ultimately broke higher, right? Something like this. This right here is this whole scenario, okay? So let's take a look. When you see this move, a lot of people would be thinking sells right here. Okay, but this is against the trend currently. You have strong bullish momentum coming right into this level of resistance, and it's not even that strong of an area, and it's not a higher time frame area. If you're gonna look for sells, a good area could be here, which is why there's the reaction right here. This would be a higher time frame point of interest. But right here is not. This is new structure. This is a new bullish structure. So when you see a higher low and momentum coming right back into it, you should expect a continuation. You shouldn't expect reversals unless it's at a higher time frame area with influence as well. As you can see, this is a higher time frame area too, where price ultimately drove up and then reversed from. But in these middle of the trend areas, we're seeing support and resistance being made. It's meant to trick you. Okay, it's meant to trick you to do the opposite of what's happening currently. So right here, see some inducement, see a range, see some choppiness. All right, buyers got stuck right here, sellers jumped in. Breakout traders might have sold right at that low, got stuck, they're in some drawdown. Some buyers jumped in, might have closed, or they're holding, anticipating the bullish movement, which you should. Breakout traders / sellers got in right here again, trapped, market reversed. Came right up and broke this lower time frame area right here. Okay, this right here you can call a change of character if you want, but essentially if the market was going to continue lower, right, it would break through, retest, and continue lower like in the last example. But this time we didn't break, we had a strong bullish close. This candle broke right above. Now there is a wick rejection here, yes, but this is meant to trick you into thinking that it's not going to continue higher, which is why this next following candle just impulsed and broke right through. When the market isn't making lower low points and continuing to respect a previous area of resistance and now support and as acting as market structure, you need to look to continue in the direction. You need to look to take trades in the direction that it's moving, which would be bullish right now. Okay, so here's some scenarios. Sellers would have jumped in right here expecting this to be the top, targeting, you know, maybe their take probably would have been this point here, and then they're maybe targeting the lows as well. Should be down here. Okay, so next, buyers would have got in, anticipating a breakout. Like we have this move right here. They're expecting that right here. And I've been in this situation multiple times, taking the buy, right? At that point, expecting a higher high and then it reversing and then taking the exact opposite, taking the sells because I'm like, oh, it's bearish now. But then you get trapped to this inducement in this range. You know, a lot of times you might take 1 or 2 losses and then stay out, or you might take multiple losses trying to revenge trade and make your money back before the move ends up happening in the direction that you thought it was going to in the first place. So you took all those unnecessary losses instead of just waiting. You know, you got trapped on this buy, although in theory this was a good trade idea, but ultimately it was the wrong time. It's the wrong time because you have to wait for price to come back to this area and test it, and for these bullish candles to form and then lower time frame structure to break. You have to wait for all these different things to happen before that move happens. Okay, and this happened during a high volume time during New York session. Right at 5 a.m. was this candle, and then this candle was at 7 a.m. right at the start of New York session, okay? So it's important to know what session you are in, when they end, when they start. And this was all during Asia and London session. So there was a breakout beforehand. Then the following day, it ranged a little bit before breaking out again in New York session. Okay, so a lot of times the inducement happens. It can happen for a whole trading session. It can happen for 2 trading sessions. If it's ranging for a little while, then you know a movement's getting cooked up, and you gotta wait for the inducement, for the rejection to either side before deciding which direction of the market you're going to enter on. Okay, a lot of times this happens before news, or a lot of times it just happens in between the end and beginning of a new session, new trading session, okay? These are the only examples I'm going to go over, but yeah, right after you broke out with strong volume, when there is not strong volume, like how we have right here, when it doesn't have strong volume like this, here in the ellipse, I'm gonna finish this up real quick and then to end the video. But if there's not strong volume like this and you get a wick rejection like this, and you'll notice it because it rejects very quickly. You know, don't stay in when you see this. Okay, that's how you know when it's going to go. It doesn't do this at all. I promise you. When you are trading and you see the market go in your favor and then go back really quickly, you need to get out because it does not do that when it goes in your favor. You see, it worked right here. In this situation, you know, it would have came down to trade management, you trusting your analysis, you know, moving stops to break even, whatever it is. You know, sometimes you have to take break even trades. right? For example, if you would have bought right here, right on the low, right on this little pullback, anticipating this movement, right? You would have had your stop loss right below here. You would have had this market pushed. You would have had a total of 70 pips, 70, 80 pips, and then the market came back and the candle closed for 20 pips. You know, you would have had to use your own judgment right there. Do you close? Do you look for re-entry? Do you hold and trust your analysis? Do you take the trade again on the break of resistance? On the impulse entry? You know, whatever it is, whatever your strategy is, however you trade, all we can do is adapt, and there's nothing wrong with exiting and entering a trade again, okay? It's all about trade management, it's all about risk management, and at the end of the day, you have to secure your gains, okay? I'll see you guys in the next 2 videos, but I hope you guys got a lot out of this. Don't forget to like this video, subscribe to the channel, join the free Telegram and Discord if you haven't, follow the Instagrams, and I'll see you in the next video. Peace!